Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to talk about yield curve inversion. I think a lot of people hear it, they see it, they hear people talk about it on YouTube. I would like to put some data behind it. I'd like to put some charts and graphs so people better understand what it exactly means and what my interpretation of it is. I do not have a financial background. My background is in mathematics, physics, and engineering. So that's my background. And I'm not touting that I'm the best physicist or mathematician or anything like that. That's just my background. It's engineering, it's looking at data, interpreting data from the given, and then drawing conclusions from that data. Um, what we have is we've got a lot of people talking about an inversion of a yield curve. What does the inversion of the yield curve mean? When does it happen? And why do we generally see a slowdown or recession after the inversion of the yield curve? What does it all mean? I hear a lot of people just throw it out. Oh, well, the inversion of the yield curve, we're going to have a recession. Okay, so what is driving the yield curve inversion? What is going to drive the uninversion or the normalization, or however you want to call it, of that yield curve? Why is it happening? And I don't really hear anybody say why it's happening. Now, I've got my theories that I'm going to present here of why it is occurring. And obviously, there's going to be some nuances in history that a yield curve inverted, but didn't, in fact, result in a recession, but majority of the time they do. And this is where I get a little bit chapped a little bit because I don't think people understand where this is coming. They're throwing out data and they don't have a good valid reason why it's occurring. So if you don't know why something's occurring, they'll make conclusions like the yield curve predicts a recession. It's like, well, it's not predicting anything. It's a measurement of where you are in a cycle. It is a measurement of where you are in the cycle, but it doesn't tell you exactly where you are in the cycle. I think you have to look at other leading indicators of where you could potentially be in the cycle. And that is where I am always trying to drive, at least through my investing, what is causing what? What are the leading indicators? What is driving this? So I'm going to dive into yield curve inversion and my interpretation of what it means. This is where it stemmed. This is the thing that stemmed it all. It says, it is my understanding the recession comes after yield uninverts. What say you? Question mark. Well, let's go into it, guys. I've got a presentation here that I threw together. It's not a huge one. And what I ultimately think is driving yield curve inversion is the demographic. That is what's driving yield curve inversion. It is that simple. And the demographic is what puts us in certain spots of the business cycle. It is the demographic interacting with the real estate market, which then sets the tone for where we are in the business cycle. I've showed this before, annual percent change in population. When these guys go up and when it interacts with the real estate market, we get yield curve inversion. And every time we have a shortage of homes that need to be built, we go into an expansionary phase, it creates inflation. So the ultimate driver of everything that I have seen is demographic related, and I can't find a single thing that is basically contradicting that. If you have a demographic that falls massively, you will have problems in your society with deflation or massive disinflation. Think of Japan, think of China right now, where the demographic declines after a certain age, which is generally around the 30s. After, if the majority of the people are in their 30s and aging past that, and you have a smaller population below 30, they generally have a problem because home prices go down, credit contracts, and you have deflationary pressures from the credit expansion side. And that drives inflation and deflation. So this is what drives it. This also drives it. The US housing market is short 6.5 million homes, posted in March 8th, 2023. You can debate whatever you want about this. I am taking family formations compared to how many homes are available and the data that is currently available. The shortages are somewhere between 3 and 7 million homes. And it's growing right now because we're not building enough homes to keep up with family formation. There's also immigration that can come into a country that can also manipulate these numbers a little bit. So now that we know that demographic drives it, we know that we are short in the housing market, those are the interactions that interact with the yield curve inversion and inflation. And that is what you're going to have to look at this from, is from that paradigm. So when I look at the yield curve inversion, this is what people are worried about right now. This is current state. We had a curve invert in the late 80s. We had the curve invert in 2000, the curve invert late 2000s, and then we have another yield curve inversion that is coming back down. The inversion is where people are saying that unemployment's going to go up, that we're going to potentially have a recession. And that is, they don't know exactly, maybe perhaps why the yield curve's inverting. At least a lot of the people that I am following, I don't hear them clearly state why the yield curve inverts and uninverts. They just think it all magically predicts things. So this is a long-term US yield curve steepness. This is the short-term yield versus the long-term yield spread. It is said that the yield curve inverts when it goes below zero. And this goes all the way back to 1962 to 2018. This is the long-term chart. This is the most recent data. You can see that we are inverting here with the most recent data. So we are down in levels that are minus 1%, which would be in this level over here. That is where we're at. We're down here. So when we look at this, this is what it means, okay? Number one, this is an inversion without a recession. So we inverted here, no recession. And then the green ones are inversions with recessions. As we go through the business cycle, AKA the real estate cycle, what happens is we go into a shortage of homes. They build, and when they go into a shortage, they start building a lot more homes. We have a low inventory level. And when that low inventory level is hit, there's more people wanting to buy homes, so they go buy a bunch of brand new homes. Those brand new homes increase the credit supply in the system. That credit supply is money supply. So when it increases the inflation in the system. When that inflation comes into the system, the bond market reacts with selling pressure in the bond market. This interaction of the demographic with the real estate market creating the credit growth, and then the credit growth interacting with the bond market is causing the yield curve to move up and down. It inverts when you have an inflationary impulse. It uninverts when you build too many homes and you have a hyper supply in the system, and you get a consequence of that deflationary deleveraging force with the construction cycle collapsing. So what we're looking at is more or less the real estate cycle to some extent. There are few instances in this chart that are not driven by the real estate cycle, but arguably could be driven by the real estate cycle, and I will describe why that could be. But it's more like more or less driven by the real estate cycle with a few oddities in this chart. So if we were to look at when the yield curve inverted, what we're going to notice is that if I were to tie this to economics in the system, and I were to tie it to real estate cycle, that they're all going to align pretty well. So an inversion of the yield curve in the mid 60s, and then also in 1969 or so. And we were to go to the real estate cycle here. What do we have? We've got the mid 60s here that went up. We went into a little bit of a housing surplus and came back down. 69, 70, we had another surplus, came back down. Another one in 74, 75, 76 came back down. If we were to look at 74, I bet you we have a yield curve inversion. 74 yield curve inversion. Do you see how those are correlated? Mid 60s, 66 yield curve inversion, 69, 70 yield curve inversion, mid 70s yield curve inversion. High inventory decline, high inventory decline, high inventory decline. What about this? 1980, we got into high inventory. So I bet you around 79, we had 78, 77, 78, 79, we had the yield curve invert. There we go, the uninversion. Yield curve invert, uninversion. We've got another yield curve inversion in 89. Oh, look, 89 had a real estate bubble that crashed. Remember, this is inventory. So right before when this spikes, that's when the yield curve uninverts. So in 1990, we should be seeing a yield curve that uninverts right before it, and there it is. What's driving this is your real estate market. Your real estate market is driving the yield curve. The demographic is driving the yield curve. So what could one conclude if that is true? The conclusion is the demographic in the United States coming into home buying years, and as that demographic interacts with the real estate market and creates a boom bust cycle, those boom bust cycles are creating or are the leading driver of asset prices in the system. And money rotates and flows differently when credit comes into the system and when credit leaves the system or gets destroyed. And we can go and look at every single one. Now, the only one that I don't know what kind of happened here, I have my theories, is when this declines here and we went into a rate hiking cycle, came all the way back down, they basically dropped interest rates and flooded the system with a bunch of bad loans in the early 2000s. They created a housing bubble, which is this big thing here. Now, the 2000s didn't have an increase in the beginning of that. When they were increasing the interest rate, we had stable inventory that went sideways at 4 months for a good period of time. Then they blew the housing bubble up, and that's where all this inventory came from, and the destruction of the credit with the deleveraging that occurred with all the loans that went bad when people went underwater. So there is one spot in this in this yield curve that went in, it inverted, uninverted, and then we came back right back to it when they lowered interest rates. Now that could potentially happen with the current cycle that we're in. Is that we raise interest rates too high, Powell, quote, breaks something in the system. He leaves it up there, and this thing uninverts. Now, would I bet on that? No way. I would not bet on that because it's the interaction of the demographic with the real estate market. We're short 6.5 million homes. With a demographic that peaks, if you had 36 years for first-time home buyers, that peaks in 2028. The buying pressure in the market. So you've got max buying pressure that we're in the middle of a gigantic upswing for buying pressure for the millennials coming into home buying years. And we're short 6.5 million homes, which means this yield curve should stay inverted for a long time. And it should maybe even go lower and invert even more potentially, because the max pressure on home buying is when your inventory runs out and the new home starts start to ramp up. And that's kind of where we're at. We're in that mid-cycle wobble where people are trying to figure out what the heck is going on. So we have a slowdown in the market, but the slowdown in the market is from basically the yield curve inverting, which is interest rates increasing. The problem is interest rates are going to have to continue to increase because we're in the thick of a demographic coming into home buying years. I don't think this is necessarily going to uninvert and stay uninverted. So, I mean, it's possible we come back, but if they lower interest rates, it's going to come right back down into an inversion. It could do something like this, which is possible. But I wouldn't bet on it because we're in the thick of this. We're right in max buying pressure for that age group. And we're also in the lowest portion of inventory. And Powell is trying to slow it all down. So that is why this yield curve inverted to where it is. It inverted rapidly because he's trying to slow down inflation, which is being driven by the new home builds and the stimulus money that was put in the system. And we're in the thick of the millennials coming through that home buying pressure. And that's where I think people may not understand where the yield curve inversion is coming from. It's coming from the rate hiking cycle, which occurs under an expansionary phase of real estate. And that's where, in my opinion, it's coming from. Now, why is this so important? Well, it's important because whenever the yield curve uninverts, we get these large declines in the overall stock market. And we also generally see a large kind of widespread sell-off in everything. And that's why it matters. Its yield curves are topping. The process is close, it says close cousins, but it almost always inevitably gets a pretty large pullback in the markets, or we get these recessions that we've got all lined up across all these things. So that is what I think the yield curve inversion is. That is where I think it's coming from. It is coming from inflation. And then the question is the demographic going to continue to pump inflation into the system? Deficit spending, we've seen a lot of stuff so let's go back and go back to the given. So this is a given. In a fractional reserve lending system, the majority of the credit in the system comes from loans in the commercial banks. So the loans coming from the commercial banks is creating that inflation. It's the demographic interacting with the commercial banking system and the credit that's being created against those new homes, because new homes is fresh new credit, 100% being added to the system. It is a supply or it's a credit add. It's not a person buying an existing asset and creating a loan. Now, if there's a loan that's created, someone owns their home and a new person buys that home with credit, that would be new credit coming into the system. But if there's a loan already on the system and someone buys it with another loan, it's the difference in the loan amount that is causing the credit growth. So you have the fastest credit growth in the system occurs when you have new homes entering the system in big quantities, because that is where a gigantic fresh amount of new credit is coming into the system. And that is where I think all of these yield curves are inverting, is from that. You can debate it. You can put it in the comments section if you disagree, but that's how I see it, and that's what lines up with history. Now, if I'm right, and we're in the thick of this thing, and the yield curve continues to invert, that means that commodities will continue to go higher. Commodities, when the yield curve inverts, is where people run to. It's under those inflationary impulses. Now, a lot of people probably think that this inflationary impulse is over. I don't think so, because we've got the demographic interacting with the housing market that is still in the thick of it. We have a lot more people that need homes to live in. We also can see that the existing inventories are low. Now, I understand a lot of people will debate that some people could potentially pass away in the baby boomers and that homes are going to come to market. And they come up with these big theories. Those theories don't matter because you just have to look at the existing inventory. That is the intersection between supply and demand. And if it is low, it is low. Your theory is wrong until proven right. We need to see the inventory come on, and we need to see it have an impact in existing inventory. We don't have that yet. And what we're going to do is we're going to put our eyes on the new housing starts. The housing starts continue to increase. You get your commodity bull market. You get your credit expansion. If the credit expansion continues to go into the system and we really start to ramp new house starts, we're going to see inflation. It also is paired with people who are coming into their age where they're going to be spending more as well. So you're going to see a velocity of money kick up too, potentially. It's just the way that when people come into these years of their life, they spend more, they buy things, they get a loan, they buy a house. It's just a part of life. So that's what I noticed, and that's what I'm seeing. And that is why the yield curve's inverted, in my opinion. One could argue that the yield curve may uninvert and then reinvert again. And you know what? That is very well a possible case. I'm not denying that it can't uninvert in the short term because of whatever factor. Maybe they dumped too much stimulus money into the system, and maybe the interest rates are at an unsustainable level for the housing market to really take off. That is a possibility, which means when the interest rates come back down to a more sustainable level, I think it's going to kick back up again, which means the yield curve will invert again to some level, to some extent, whatever that level is, because of inflation driven by the credit expansion in the system. So that's it, guys. That's my theory. Thumb up on the content, subscribe to the channel, subscribe to the website if you guys like this type of analysis. That's where I go into individual companies and what I'm looking at for potential companies to play the commodity bull market with. Obviously, you can swing for the fence with speculative companies that don't have much earnings. You're speculating on price growth, or you can play this through dividend payers, where you are protecting your wealth against inflation and increasing dividends with commodity type companies. All right, guys. Oh, and don't forget, I do have a discount going on July 4th. It's in the comment section below. If you want to join, it is 50% off for only a short period of window for July 4th. It closes on July 5th, and it's for just 1 month at a 50% discount, so you guys can try it out and see what it's like. All right, guys, that's what I've got for today. We'll catch you later. This is Finding Value.